Let's get the obvious out of the way first. Okay, my name is Scott Groves. I'm a loan officer. I also have a coaching company that helps coach loan officers on the weekends, kind of my passion project. At the end of the day, I'm not a health professional. I am not a prognosticator. I don't know how this is all going to turn out with COVID-19. I'm not a CPA. I'm not an accountant. I'm not giving you financial advice. I'm just staying in my lane and talking to you about mortgage stuff that's relevant maybe in your life right now. Or if you're a realtor, you need to get this information out to your clients. Feel free to find me on Facebook, Scott Groves, reshare this video. We'll probably go about 20 minutes just answering all of your questions, going over some bullet points that I have prepared to talk about, and we'll go from there. So again, I want to make sure that just because I'm only talking about mortgages and forbearances, I'm not unsympathetic to the fact that there's a lot of people dealing with the reality of health crises in their family, in their community. You know, at the end of the day, everything I'm going to say is some guidelines, some suggestions, some of my personal experience working with clients and kind of just the overall economy, because housing is the biggest driver of economy in America for the last 20 years. But again, you, if you're watching this, have to do whatever's best for you and your family and the financial health of your well-being. So with all of that out of the way, I just want you to know, like, if you're in dire straits right now, you know, you've lost your job or you have no money in reserves, or it's really coming down to those household economic decisions of like, hey, do I pay this bill or that bill, or do I eat, or do, you know, those things are horrendous. And I don't claim to understand for you what might be going on with your family. So make the decisions that are best for your family. I just want to give you some education on what's going on and what's available. Okay, so as part of the Stimulus Act that was just passed, somewhere around $2.2 billion, it's being called the CARE Act. The government put in a provision in there, which frankly is not particularly well thought out. And they said, okay, homeowners, if you have a challenge, and right now there is no definition of what that challenge is. You don't have to be currently contracted COVID-19. You just need to basically tell your loan servicer that you have challenges making your mortgage payment, and your payment can go on forbearance. Forbearance is the key word that you want to know about. Can go on forbearance for 3 months. So let's say, for example, you logged on yesterday, March 31st, to Quicken or Dove and Mule or Chase or Wells Fargo or Caliber, any of these companies that service loans. And I'll give you guys toward the end of the call a little bit more technical knowledge about kind of the life cycle of your mortgage. Who's the servicer, who's the investor, who's the mortgage professional who originated. I'll give you that education, but let's just go through what you'll be dealing with right now if you're a consumer. So you jump on, let's just go with Quicken Mortgage, right? Quicken Mortgage is one of the big servicers. They actually bought my loan. So you go on Quicken and you say, okay, I'm having some financial hardship. I want to be given a forbearance on my mortgage payment. And they say, okay, no problem. You're automatically approved because, again, the CARE package or the stimulus package didn't really lay out what a hardship means. You just have to call up and say you have a hardship. So they immediately on the spot approve you for a forbearance. Now, some of the better loan servicers, the people you make your mortgage payment to, they have online portals set up where this is done instantaneous. Some of the companies and loan servicers and banks that are a little bit more behind the technology curve, I've heard people having to sit on hold for 3 hours, 2 hours, an hour, just to get through to the right person to have this conversation. But regardless, somehow you get approved for the forbearance. And what the forbearance means is that you don't have to make payments for 90 days, 3 months, 3 monthly payments, but that payment gets tacked on to the first mortgage payment that's due in 90 days. So, for example, you filled this out yesterday, you get approved, sweet. You didn't quite understand what you were doing, but you feel good because cash flow is going to be a little bit tight. Maybe your spouse got laid off and you're like, hey, I could probably make my mortgage payment, but I'd rather just have this leeway of the extra $2,500 a month. We'll use $2,500 a month as our kind of projected loan payment. So $2,500 a month, you'd feel way better if you didn't have to pay that for the next 3 months. You short up your cash flow, you're feeling good about it. Today you get all the paperwork in the mail explaining that what forbearance is. And there's two big things there that you may have overlooked, or you probably did overlook. $2,500 April 1st, $2,500 May 1st, $2,500 June 1st. On July 1st, when you get your mortgage payment for July 1st, your bill is going to be $10,000. They didn't forgive the 3 months of payments. They didn't automatically tack it on to the end of your loan in 25 years when you think you're going to be done and you have 3 additional monthly payments. They're not amortizing that $7,500 in payments that you skipped out over 6 months or a year or 2 years. They're just saying, okay, cool, you got some cash flow issues right now based on COVID-19. We'll give you a 3-month reprieve, but then all that money is due on July 1st. And here's where I think that we're really screwing up as an industry, as mortgage professionals, as loan servicing companies, of not getting this information out to consumers, is like, no offense, but if you're in a financial situation where you weren't going to have $2,500 on April 1st or $2,500 on May 1st, you probably are not going to have $10,000 on July 1st, right? If you're in a service industry job, if you're self-employed, it's not like all of a sudden 90 days from now, I like to think of the girl that cuts my hair, right? Her being off work for 90 days, I'm not going to go in there on May 15th or June 1st, whenever this COVID shelter in place is lifted, and say, okay, great, give me 2 haircuts. No, that revenue is lost, right? So it's not like if my hairdresser applies for this forbearance and somehow finds a way to skip the next 3 months payments, which will be pretty easy. It doesn't mean that she's going to make up all that lost revenue in May or June or July, and all of a sudden, in our hypothetical scenario, be able to pay. Sorry, I'm having a little bit of internet connectivity issues. It doesn't mean that she's going to be able to make up all that money and then pay a $10,000 mortgage payment on July 1st. So that's the first thing that we all have to understand. And if here watching on Facebook, if you have some conversation or you have some questions about forbearance versus forgiveness, please feel free to ask them now, because this is the key crux of the issue. Now, here's the next challenge. The next challenge is a bunch of people, hundreds of thousands of people, probably millions of people, are asking for forbearance on their mortgage, not understanding what's going on. Then on July 1st or August 1st or September 1st, depending on when they made that forbearance active, and now it's 90 days later and they get the bill and they say, oh shit, this didn't get amortized on to the end of my loan. This didn't get spread out over a year. I just owe the whole balance now. I don't have, in my hypothetical situation, I don't have the $10,000 in July because we're still recovering. I didn't get back pay. That revenue is lost forever, whatever the case may be. Well, now I have to get on the phone with my loan servicer, and I need to apply for, pick any number of ideas that could come back to the financial industry. You could maybe apply to have another forbearance, or to have that payment tacked onto the end of your loan, or amortized out over a year or 2 years, or you do a full-time loan modification or a long-term loan modification. The problem is, and this is where I'm going to try to stay financial and not political, the problem is our government comes up with these great ideas in the moment, but if you call your loan servicer and say, okay, well, in 30 days, 90 days, what are my options? The options that are currently being given is, we're not sure. You can pay in a lump sum. Maybe we'll allow you to reapply in 90 days to take that 3-month forbearance and apply it over the course of the year. Maybe we will allow you to apply and apply it to your end of your mortgage. Maybe we will allow you to apply and just forgive the amount. But the reality is, does anybody think, between the government and the banking system and what we saw after 2008, where the right hand wasn't talking to the left hand, does anybody think we're really going to get to July 1st and there's going to be just this smooth, steady plan that's in place for all loan servicers, where they're like, okay, cool, Scott, you didn't make your April, May, June payment. Now July is due, and you owe $10,000 because it's basically the 3 months you skipped plus this new monthly payment of $2,500. I just don't trust the banks and the loan servicers to have their shit together to be able to say, okay, here's the new plan. You take your $10,000, you amortize it over a year. Your payment's going from, $2,800 to from $2,500 to $2,800. I just don't trust them to do this, because we have an example of this exact scenario from 10 years ago, right? The government came out and said, okay, Fannie and Freddie Mac, Fannie Mae, Freddie Mac, the 2 big loan aggregators that buy all this debt, we want to help Americans. We're going to introduce the HARP program. So HARP was Home Assistance, something protection plan. And they said, all you got to do is do this thing and call your servicer, and we'll help you work out a mortgage payment plan and a loan modification. And you can just read horror story after horror story after horror story about how loan servicing was not talking to the foreclosure department, was not really in line with what the government wanted them to do, and didn't really know what to do. And so you got these people that were told, hey, just don't make your payment for 6 months, and then we'll approve your loan modification, or we'll approve a forbearance, or we'll approve a forgiveness. And I'm guessing everybody that's watching this, either live on Facebook or you have questions right now, like in the chat box right now, I would love to hear from you. If you know somebody back in 2008, 2009, who got bad advice from their own bank on what to do with either a loan modification or whether or not they should make their payments. Again, the left hand was not talking to the right hand, and it just became a cluster. So again, going back to my original problems, if you are dealing with real cash flow issues, if you're having to make those tough household economic decisions of like, hey, what bill do I pay? Or am I going to be able to put food on the table? By all means, do whatever you have to do to right that situation. And hopefully we're all back to work sooner rather than later. My personal advice is that if you have the means, any way, shape, or form to make your mortgage payment, just make your mortgage payment. Because the other thing that I'm concerned about is the fear of the unknown and unintended consequences. You know, right now when everybody's gung-ho, we're in this together, we just got the stimulus money, you know, everybody's very concerned about everybody else's well-being at a community level, at a national level. You know, we're kind of in this together against this COVID-19 fight. Everybody's being friendly and helpful. A year from now, and here's my big concern, a year from now, you go to apply for a car loan or a home loan or a refinance, and they say, oh, remember that 3 months of forbearance? You know, we're actually treating it as a mortgage late, or we're actually treating it as proof that you were not able to financially, you know, you weren't a financially viable borrower to pay your mortgage when things got tough. Now, again, this is me projecting and speculating and talk about some of the things that could happen. But the bottom line is no lender was prepared for this. And so no lender has clear-cut guidelines on, hey, what does this all mean? You know, when I pushed and pushed and pushed, I called 2 different loan servicing companies over the last couple of days, Quicken and Chase. And I said, hey, can I get in writing absolute positively that this will in no way affect my credit or affect my ability to refinance in the future? They both said, both loan servicers, Chase and Quicken, who service a huge amount of loans, they both said, no, we can't do that. What we can guarantee you is that whatever your mortgage status was on the day that we put you in forbearance, so if you were current on your mortgages, which I am, we can report for that next 3 months that you were current on your mortgage. But at some point, we're going to have to report a forbearance, which basically means not paid upon in the manner, not paid the agreed amount, because I agreed to make my mortgage payment every month. So at some point in the future, when the dust settles out, you know, these forbearances are going to be reported on credit in a manner that might make it difficult for future financing. And then we get into a bigger question of like, well, there's all kinds of guidelines for all different kinds of loans that says if you have a late payment on your mortgage, you cannot get a new mortgage for, depending on the guidelines, 12 months, 24 months, 36 months. Will this forbearance look like on your credit report? Will it look like a mortgage late where you can't get future mortgages? So these are all serious questions that we need to ask ourselves. A lot of people do not have the answers for this. And my concern, having worked in finance, in banking, in mortgage, and look, I work for a great mortgage company right now, but like most other mortgage companies, we sell the loans on the back end. It goes to a different servicer. I don't have control over those servicers, right? Neither do you. So my thoughts and my concerns and looking back at what happened on HARP and just kind of understanding how this stuff all kind of plays together, I'm very worried that there could be some unintended consequences that we're just not prepared to answer the questions right now. And in people's rush to get the forbearance because they're super concerned about cash flow, they might be doing themselves more harm than good. I mean, look, I've had this inner dialogue with myself. I have consulted with good friends of mine where I've thought like, hey, I'm in a fully commissioned job. I'm totally freaked out by, you know, where the mortgage market is going to go over the next 90 days. I would probably be better served for me and my family to go on forbearance and not have my $4,000 a month payment due every month to the bank. And then I'll figure it out in 90 days. I've really been having that inner conflict with myself. But at the end of the day, I just know if I have the money, if I have some savings, which is why every single person who got a loan in America over the last 10 years, you know, we analyzed their income, we analyzed their savings. We wanted to make sure that they had some equity in the house, which most Americans who have a loan have about 25% equity in their house. We also analyzed their assets to make sure that they had a few months of emergency reserves. I was underwritten the same exact way as the rest of America. So I've got a few months of emergency reserves to make my mortgage payment. I've just decided, like, I'm not going to play that game and go down that realm of headache. I'm just going to make the mortgage payment for as long as I can. And then if in 90 days or 6 months, there is a true catastrophe where I have to make those financial decisions, do I pay my mortgage or feed my family? Well, then I'll make those decisions at that time. But for now, I think it's important for, if you can, you should. And that's just the opinion that I'm taking. I do want to share this, and then we'll definitely go to some questions. I also want to make sure I don't miss this. If you're getting a forbearance or any type of agreement on your mortgage payment, that's only for your mortgage payment. That's only for your mortgage payment. That's only for your mortgage payment, the principal and interest. If you have taxes and insurance that are either paid as part of your mortgage or that you pay separately on a biannual or annual basis, you still have to keep those taxes and insurance current. So for example, and we'll go back to this $2,500 payment. Obviously, I'm thinking right now, $2,500 principal and interest. But if that client's payment is actually $3,200 because $700 a month goes to taxes and insurance, they will still be obligated to pay that $700 per month while their principal and interest is in the forbearance program. So I'm going to share my screen real quick. That's kind of the ins and outs of what's happening on the actual forbearance program. I am going to share my screen, and this is a little blurry, so I apologize, but this is just kind of important for a lot of us to understand as far as what's the life cycle of a mortgage, right? What's the life cycle of a mortgage? And why is everybody kind of freaking out right now? Some people are calling it a mortgage crisis. Some people are calling it a debt crisis. Some people are calling it liquidity problems. Some people are calling it a government problem. But if you look at this little cycle, you have this blue dot is the borrower. That's pretty obvious, right? Then you have this green dot. This is the originator. This is the mortgage professional. In this case, Scott Groves, please call me the next time you need a mortgage. If you want to refinance, I love getting all this information. Obviously, I only feed my family and pay my bills if I do mortgages. So if you're in Southern California, you need a mortgage, happy to help. Then you have the mortgage company, right? The mortgage company for me is Movement Mortgage. I do my loans through Movement Mortgage. Sometimes Movement Mortgage does the loans. Sometimes we broker it out to another source that Movement Mortgage is approved with. But these first three steps are pretty self-evident, right? You have the borrower, you have the originator, then you have the mortgage company. Now, here's the challenge. Movement Mortgage, or any mortgage company, any bank for that matter, does not have billions and trillions of dollars sitting on their balance sheet to hold all of these loans for 30 years. So what they do is every month when they fund all these loans, they wrap them up and they sell them to an investor servicer, okay? And the servicer can be Quicken Loans. It can be a bank like Wells Fargo or B of A. It can be a big servicing company like Dove & Mule or PennyMac. And this servicer turns to Movement Mortgage and says, hey, Movement Mortgage, we want to buy these 2,000 mortgages from you. We're going to wrap them up. We're going to bundle them up. The mortgage statement has come from us. So Dove & Mule, for example, is one of the ones that is a big mortgage service company. They buy the mortgage from Movement Mortgage. They are the ones that the client makes the payment to. They handle whether or not there's a foreclosure. The mortgage statement goes out in their name. This loan servicer is the person who the client is most familiar with after the loan is closed. But on the backside, the investor says, well, we also don't have enough money to keep these billions and trillions of dollars of mortgages. So we're going to keep a little bit of the money that's earned every month, and we're going to send out the mortgage statements, and we're going to be kind of the forward front face of the mortgage or of the actual debt where the client is making the payment. But we're going to turn around and sell the debt to Fannie Mae or Freddie Mac or a Wall Street hedge fund. We're going to sell the debt on the backside. Well, here's the part where I take issue with the government. The government they came in and they said, okay, borrower, this blue dot, you do not have to pay your investor servicer, the person that sends out your mortgage statement every month. You don't have to pay them for 3 months, right? But like the government is so apt to do, they wanted to make things look good for their borrower, the voters who put these people in office, but they didn't think past the first step and the unintended consequences. Because now the borrower in the blue dot is calling the investor in this kind of light blue dot down here, teal maybe, dot, and saying, hey, I don't want to make my payment for 3 months. The government says so. And the investor says, okay, well, that's great, but whether you make your payment or not, we still have to send the money over here to Fannie Mae and Wall Street and the people that own the debts, because we're contractually obligated to send the payments whether the consumer makes the payment or not. That's why the investor servicer is granted the legal right to foreclose on the borrower, because if the borrower under normal circumstances goes 3 months without making the payment, the investor, this little teal dot down here, needs to foreclose on the blue dot, the borrower, in order to get their money, get the asset, sell the house, and pay off the real investor, who is now Fannie Mae, Freddie Mac, the aggregator over here. So the unintended consequences is the government said, hey, let's spend $2.2 trillion bailing out the economy, helping the borrower, helping the little guy. Okay, cool. Whether you agree or disagree with that, you can at least understand that thought process. But what they forgot to do when they made this 3-month carve out for the borrower is they forgot that the investor has to keep paying their bills, whether or not the money comes in from the borrower or not. So now Fannie Mae, Freddie Mac, Wall Street, the investors that have all this mortgage debt is looking at this investor servicer, the loan servicer, and saying, hey man, like where's our money? We still need our money whether you're getting paid by the borrowers or not. So now there's another bailout conversation happening of like, oh man, if these loan servicers don't exist, the mortgage company has nobody to sell to. If the mortgage company has nobody to sell to, the originator can't make new loans. If the originator can't make new loans, the borrowers who want to refinance or save money or buy a new home, they can't get a loan originated. So it's this kind of vicious backstop of the cycle. And now the government is talking about, okay, well, we bailed out the borrowers. We forgot about the investors, because now we've got, several million borrowers saying they don't want to pay the investor servicer. And the investor servicer is looking at Fannie Mae, Freddie Mac saying, hey, we'd love to pay our bills this month, but we just can't because of this new kind of moral hazard that the government put out there to all these borrowers and said, don't pay your mortgage. So, if we want to go back to this kind of John F. Kennedy quote, right, of like, ask not what your country can do for you, but what you can do for your country. It's kind of like, if you have the means, if you can make the payment, ask not what your mortgage company can do for you, but ask what you can do for your mortgage company, which is maybe stay on track with your monthly payments, because that allows the debt servicer, the investor servicer, to collect the payments, pay Fannie Mae, pay Freddie Mac, pay all the Wall Street banks that financed all this debt so you and I could buy houses. And I think this is kind of the important thing that people are not talking about. So let me stop talking. I just threw up 20 minutes of information. I'm going to go to the comments real quick, see if there's anything there. Danielle's been watching the comments on Facebook. Anything on Facebook that we need to answer right away?
Steve Clark likes your shirt.
Thank you, Steve. This is a company called, I'll look them up real quick. I really love them. I love them so much I forgot their name. Oh, myprojectx.com. They make the best surf clothing and fake people like me that don't surf anymore. They make great stuff. So thank you, Steve Clark. What other questions do we have? Cool. I got a bunch of questions here on Zoom. So is forbearance considered a loan default? Ron, that is a great question. And the answer is nobody knows. Right now, the servicers, and this is my personal opinion, right now the servicers are telling you whatever they need to tell you to get off the phone, accept your forbearance, and move on to the next client, because there are so many people in the queue trying to get information, right? And I understand it. For these loan servicers, these call centers, their quickest path is to get you the forbearance, get you off the phone. They don't have the 20 or 30 minutes per call like we're doing right now to educate you on all this means. So I believe the technical answer right now on the ground is that a forbearance is not considered a default. The problem is, think about 6 months from now when things return to normal, right? If you were a lender, if you were an underwriter, if you were Fannie Mae or Freddie Mac, who writes all the guidelines for these mortgages, how would you feel about somebody who didn't make their loan payment? Now look, again, going back to my very first comment, I know that there's people that are in true financial hardships and can't make their payments. But if we think about this, the purchase market in housing, the refinance market, kind of the overall economy was booming until about the end of February, middle of March. So, if we just look at the overall global factor, and I know all of these thoughts go out the window immediately if you lost your job 2 weeks ago. So again, I'm sympathetic to those people. But really, we're about 2 or 3 weeks into an economic slowdown. most homeowners, especially here in California, where we don't do a ton of FHA and VA loans, we do a lot of conventional loans, 10% down, 20% down. Most people that have bought a home in the last 10 years in Southern California have 10, 20, 30, 40% equity. They've got 6, 12, 24 months of emergency assets in the bank. And if you are the person that have those assets, you have the ability to repay, and effectively 2 or 3 weeks into an economic slowdown, you're asking to not make your mortgage payment, how can the underwriters not consider that in the future when they're underwriting future loans? So I don't know that a forbearance will ever technically be considered a loan default on your credit report or on your mortgage application, but we best believe that in the future, underwriters are going to use that as a piece of evidence when they're underwriting future mortgage transactions. Belinda says, I've been an originator for over 20 years. HARP, that 2008 program, helped people only that did not miss or skip a payment. If you're going to do a loan modification or forbearance, you will need to read the fine print. Yeah, that's absolutely true. Ironically, what the loan servicers and the government were telling people to do in 2008 was like, oh no, go ahead and miss 6 months of payments. That will prove that you have a hardship, and then we'll give you a loan modification. But most of the people that got the loan modification were the people that kept making their payment throughout the hardship times, and then they got a loan modification. So is the forbearance only good for owner-occupied residents or also for income property? Diane, that's a great question. I have heard when I was talking yesterday to Quicken that they're kind of just blanket approving everything and they'll figure it out on the backside. So if I was a borrower, I would think that you could probably get a forbearance on your investment properties, but you're definitely going to want to read the fine print, because in a rush to approve these forbearances so that, Quicken doesn't have the bad PR of they denied a forbearance for somebody who denied a forbearance for somebody who deserved it, they may end up approving some forbearances that they shouldn't. So if you are a property investor, I would really read the fine print. Is there any information in the news that instead of paying back 3 months of payments in 90 days, they would then add it to the loan term at the end? Eddie, that's absolutely true. We're seeing a lot of news where now that servicers are accepting the forbearance, now they're having to project 90 days out and be like, oh my God, well, what do we do in my hypothetical situation if we get 90 days from now and the client doesn't have $10,000? So smart companies that are forward thinking, they are already thinking about what is my next step? Do we allow them to tack it on to the end of the loan? Do we amortize it out over a year? The problem is nobody has the exact plan or the exact guidance from these servicers or the government. And it's my experience, when banks don't have a plan, they screw things up. When the government doesn't have a plan, they screw things up. So I don't want to be stuck in the middle of a screw up, accidentally having a mortgage late payment that I then have to dispute. And then I have to, there would be so much mental energy that gets wasted in trying to sort this out that I rather just tighten my belt, cancel the Netflix if I have to, stop spending in other places and find a way to make my mortgage payment. All right, so if you're watching this on Facebook, if you're a realtor, a mortgage professional, I only do mortgages here in Southern California. So if you're a mortgage professional from around the country, feel free to reshare this as your own. I understand why you might not want to do that if you're in LA, because I want those loans here in LA. If you're a realtor and you have clients that need this explanation, by all means, tag them in this video, share this video from Facebook. If they're, I guess that would look weird if you tag somebody, because then it would be known publicly that they want to be behind on their mortgage. Have them call me. I'll send them a copy of this video. I'm here as a resource. Obviously, I want to keep doing loans. I want to keep doing refinances. I want to keep doing purchase loans. I want to keep being there for our realtors and our couple thousand past clients. But I think one of the best things we can do as loan officer professionals and as realtor professionals, one of the best things we can do is just pass this information on to our clients with some empathy and sympathy, and understand like, hey, if you're in a really bad spot, do what you have to do to take care of your family. But if you have the means to make your mortgage payment, please make your mortgage payment. It's going to be better for you. It's going to be better for your loan servicer. It's going to be better for the overall economy. And as soon as the health scare passes, we can get back to business as normal financially in our industry and with the overall economy.
We got some questions.
Oh, okay. Now there's some questions here.
All right. Tim would like to know, do loan servicers have insurance that would cover underpayment from borrowers?
I have no idea how loan servicers work. I just know it's a giant industry built on super tiny margins, billions of dollars in reserves to kind of weather the storm. It's because it's a super low margin business with super high volume. You know, we're talking about these people scraping off 0.1% or 0.2% on trillions of dollars of mortgages. So my guess is they have some type of insurance in place, but nothing that would prepare them for the federal government and every news anchor on CNBC and Fox and MSNBC to go tell the entire United States population, oh, you don't have to make your mortgage payment. Like, nobody is insured for that. You know, just imagine if State Farm or Geico or Allstate, just imagine if everybody in the country got into a car accident at the same time. There would cease to be car insurance companies. So I think that's kind of what we're dealing right now, that when the government, you know, makes these plans, they mean well, but there's just so many unintended consequences. So, all right, guys, I love you lots. I'm here as a resource. And yeah, just if you're a realtor and you need any follow-up information, you need me to talk to a client, you need me to download this video and send it to a client because they're embarrassed to watch it or comment it on Facebook, send me an email, Scott@Scott Groves Team. I will put all the information up in the Zoom link here, and I will also put it on Facebook, and I'll stick around for like 60 more seconds just in case a question comes to your mind.
We got another one.
Yes, another question.
It says, taxes are coming up and escrow accounts will be used to pay. Are there any talks about the possibility of going negative with escrow accounts from Angel?
Yeah, this is a really good question, Angel. Taxes are due here, like in LA County, what are they due March 15th, late April 15th. So if you already have a mortgage, you should have been paying in every month. If you have a mortgage with an impound account, you should have been paying in every month over the last 6 months. So this set of taxes that are due now will kind of go out as scheduled. The problem is your next set of taxes, if you're in LA County, are due in October, late in November, due November, late December, whatever it is. And the way that they balance is that every month when you're making your mortgage payment, you make an additional little chunk of that mortgage payment gets held in an impound account for your taxes and your insurance. And then in October and November, when we get to tax time, they send out those taxes for you. Well, if you're not making your payment, then really what would happen to fund that impound account is the servicer would have to go negative and lend that money from them to your impound account so that all the money is there for your taxes and insurance when the time comes. That's why even if you get a forbearance and they scrape off the principal and interest and you don't have to pay the principal and interest for 3 months, you still have to pay your taxes and insurance because they can't allow that impound account to go negative, because what the servicer would basically be doing is lending you that money every month. And the servicers aren't in the business of lending money. So if you have a tax and insurance situation that you pay on your own, you just got to keep paying it on your own or deal with the late payments with your county assessor. If you have an impound account, even if you get a forbearance, even if you work something out, taxes and insurance are still going to be due every month. And I'll tell you, in my humble opinion, this is the real dangerous part, because if you want to know why properties get foreclosed on, it's rarely because of the loan. Like, lenders are not in the business of foreclosing property. You know, a lot of times I'll have people say, oh, well, you know, I only owe $600,000 on this house that's worth $800,000. Why won't they give me a loan? They should be lucky if I foreclose, because then the bank makes 200 grand. That's not the case at all. By the time a loan servicer goes through a foreclosure process, they pay the mortgage themselves for 6 months while they're trying to get you out. The property is trashed by the time you leave. So instead of it being worth $800,000, it's worth $750,000. Then they have to pay realtors. Then they have to pay the carrying costs and the taxes. Lenders don't want to foreclose. No matter how much equity is in the house, there is no lender in America that wants to foreclose and make money off of the equity in your house. So it's very rare that a house goes to foreclosure because of the lender. House is going to foreclosure because of back taxes. That shit happens all the time. So I would be very worried for anybody who doesn't understand this and starts to get habitually behind in their tax payment. That's where things can get pretty ugly. Can you send the graphic which shows the lender cycle? Yeah, Tracy, by all means, just email me, Scott@Scott Groves Team. I'll send you out that little graphic that I had that had kind of the life cycle of the loan process. Ron, if you send partial payments to cover your insurance and taxes, how do you make sure the lender applies it towards that and not towards the interest and principal? Ron, this is another great unknown and another problem, right? If you've ever had an accidental overdraft on your checking account, or the other day, for example, with Chase, I tried to open up a new business savings account online with them. It froze my account and it did this and it sent up this red flag. And it was like 3 days trying to get that fixed. And so when the loan servicers are saying, oh yeah, hey, just trust us, we've somehow reprogrammed our entire electronic system of incoming mortgage payments to understand a 3-month forbearance and keep sending in your taxes and insurance. We'll be sure it goes to the right place. Ron, this is another thing that I'd be terrified about is like, okay, well, did the payment that was supposed to go to taxes and insurance accidentally get applied to a portion of the principal and interest? And now that I paid a portion of the principal and interest, it kicked me out of the forbearance. So now I don't have a forbearance. Now I have a mortgage late. These are all the unintended consequences that are going to happen if you take advantage of this program. So that's what I'm saying. Again, very sympathetic to the people that are in dire straits right now. But if you have the means to make your mortgage payments, I promise you, you are going to solve so many future problems by just making your payments on the regularly scheduled timeline. Can you send the graphic which shows, yeah, Tracy, just, I already read that question. Tracy, just shoot me an email and I'll send that to you, that graphic. Scott at Scott Grove's team. Any other questions from Facebook? All good?
Will you just go over the credit score one more time?
Yeah, credit score. Number one way to improve your credit score is make all your payments on time. I don't care how we slice it. A forbearance means you're not making your mortgage payments on time. So could there be future ramifications? Absolutely. I just never trust the banks to do all the right things in favor of the consumer. How will it affect buying a house in 6 months if you get into a forbearance? Tracy, this is another huge unknown. And again, there's no underwriting guidelines for this because we've never been in this situation where the government has stepped in and been a backstop for every single homeowner in America. I mean, think about that. Love them or hate them, you know, Trump gets this bill passed. Love them or hate them, the heads of both party in the Senate and the House basically go out and tell everybody, hey, big win for consumers. There's part of this bill where like, you don't have to make your mortgage payment for 3 months. So there is no precedent for this. There is no currently designed underwriting guidelines on really how to address this. But I'm just thinking, as there's this huge flight to safety, right? We've seen all the minimum credit score requirements go up for underwriting guidelines. We've seen down payment requirements go up for underwriting guidelines. We've seen a lot of jumbo loans, bank statement loans, kind of more of that exotic stuff exit the market over the last 30 days. So the way I'm thinking about this is right now, banks are acting like we would act if we were lending this money with our own funds, right? Like if Scott Groves was lending Bill money to buy a house, would I want somebody with 20% down and over a 700 FICO score and a provable job? Or would I want that FHA borrower 3.5% down, 600 FICO score, is using every single dollar for the 3.5% down payment and doesn't have 2 nickels to rub together? You know, that's how the lending industry is thinking right now. They're being a little bit more common sense. And so just extrapolating out that thought process, if you go on a forbearance, how are lenders going to treat this in 6 months? Well, again, going back to the analogy of what would I do with my own money? If it's my own money and I now have proof from a buyer or a potential buyer that, hey, when things get tough, you opt in and don't pay your mortgage for 3 months. Would I want to lend my own money to that person? And I think that's the mindset that we have to have with all lending decisions right now. As lenders are tightening up, they're playing with their own money. It's not as easy for them to sell the debt out the backside to loan servicers and aggregators. You know, lenders are having to be a little bit more responsible in this tightening of the credit markets and say, okay, if it was Scott Grove's money, what would you do? So I would ask you, Tracy, if it was, which is a great question, if it was your money, would you lend to somebody that went on a forbearance, you know, within 2 or 3 weeks of having an economic slowdown? So my guess is that it's really going to be a challenge to get a home loan in the next year or so if you opted to go on this forbearance. That's just kind of how I'm thinking about it. I don't have any insider knowledge of that. I'm just kind of extrapolating out what's happened over the last 30 days in the market and how that might affect things the next 6 months or 12 months. Angela, have you stopped doing bank statement loans? We have not stopped doing bank statement loans altogether, but across the board in the industry, they have effectively disappeared from the market. There's a few players still left in the game. You know, maybe you've got to put 40% down instead of 20% down. Maybe the rates are a little bit higher if you want to go up to 80%. There's still some players in the game for those bank statement loans, but they are few and far between. If you have a client, you know, introduce them to me, shoot me an email. We can put them on the right track, either with myself or one of the people I know in the industry who can still serve that. If you don't pay your car payment because they waive the next few payments, how will that show up? Tracy, I'm guessing the same thing. I don't have any insight into how the car industry is going to treat forbearances. You know, just knowing what I know about the car industry, I would be more, I would be, I would have less faith in the car industry doing the right thing for the consumer than even the home loan industry. So yeah, that's what I got. I went much longer than I wanted to. I wanted to keep this like 20 or 30 minutes just in case somebody's watching the replay. I'm going to get going. Love you lots. Find this video on Facebook if you have additional questions, and just type them into the box. Send me a private message on Facebook. Shoot me an email, and I am more than happy to help with everything I can. All right, love you guys. And then look, when things do return to normal, I want to be your loan officer of choice because I'm here to give you information in the tough times. I also want to be here to help you with your personal loans and your clients in the good times. And frankly, I picked a great time to go back to full-time loan production and be out of management, because now I only have to deal with these concerns for my clients and my realtors, and not also the 10 or 12 people we are managing. So I'm just, I'm very grateful to be back at Movement Mortgage, and very grateful to be back in the fray of just doing home loans all day, every day. So let me know how I can help. I love you lots, and you have my email if you need some follow-up questions. Talk to you soon.